36% of Americans earning over $100,000 a year are still living paycheck to paycheck. Not people who made bad choices, not people who skipped college or never got a raise, people who did the work, got the degree, climbed the ladder, and are still doing quiet math at 11 at night, wondering why it does not add up. Here is what most financial advice gets wrong. It assumes your problem is discipline. It is not. The system you're operating inside was designed with a specific set of leaks built in, and nobody handed you the blueprint. In this video, we are going to name every one of those leaks: the housing trap, the car trap, the credit card trap, the psychological traps that keep you from seeing any of it clearly. By the end, you will understand exactly why a normal income and a normal lifestyle are almost mathematically guaranteed to keep you stuck. And look, you probably already sense this, like you are saving something. You are not buying things you cannot afford. You are doing what responsible adults are supposed to do. So why does it still feel tight? Here is where it gets interesting. Take a couple earning $110,000 a year combined. Solid income, both working. They buy a house that the bank approved them for, finance 2 reasonable cars, and put 1 kid in daycare. Standard life. By the time those fixed costs clear each month, they are running negative $350 before a single dinner out, before a streaming service, before anything unexpected. They are not irresponsible. They are just living inside a system that treats normal as a ceiling. That is the actual trap. It is not one big mistake. It is a dozen invisible ones, all running at the same time. Once you see the structure of it, you cannot unsee it. My name is Alex, and if you have ever stared at a paycheck that should be enough and genuinely could not explain where it went, stay with me, because the explanation exists, it is specific, and it is a lot more systematic than anything you have been told before. Let's start with the 2 costs that are quietly eating most of it before the month even begins. Most people assume the reason they feel financially stuck is somewhere in the middle of their budget: the subscriptions, the takeout, the impulse purchases. And sure, those things matter. But the real damage is almost always happening at the foundation, in the 2 highest fixed costs you committed to before the month even started: where you live and what you drive. Get those 2 wrong, and very little else you do with money makes much of a difference. Let's start with housing. Because this trap is especially hard to see. Not because it is obviously bad advice, but because it feels like a reward. You spend years working toward the point where a bank hands you a 6-figure approval letter. When it arrives, it genuinely feels like validation. Like a signal, you have made it. And it is easy to read that letter as permission. Here is what the bank does not tell you. When they approve you for that mortgage, they are not calculating what you can afford to live comfortably. They are calculating the maximum amount they believe you can repay without going bankrupt. Those are 2 completely different numbers. And the gap between them is where a lot of financial stress quietly lives. Look at where things stand right now. The median home price in the United States sits at around $390,000. At current mortgage rates near 7%, the monthly payment on that home, just principal and interest, runs close to $2,060. Add property taxes and insurance, and you are clearing around $2,500 before a single repair bill arrives. To stay within the standard guideline of spending no more than 30% of gross income on housing, a household needs to earn roughly $100,000 a year. The median household income sits closer to $80,000. And that gap explains a lot about why a family doing everything by the book still feels like something does not add up. But the number that really stings is not on the mortgage statement. It is everything the approval letter never mentioned. Maintenance on a median-priced home runs about 1% of the home's value per year, which is around $4,000. Add property taxes, homeowner's insurance, and the repairs that cannot wait, and you're looking at roughly $15,000 a year in ownership costs beyond the mortgage. That is over $1,200 a month that was never part of the conversation when you sat across from the loan officer. You were approved for the payment. Nobody handed you a full cost of ownership summary. Now you are probably thinking that renting is just throwing money away. That logic feels solid on the surface. But think carefully about what you are actually comparing. Owning locks in your tax bill, your insurance obligation, your repair liability, and your geographic flexibility for the next 30 years. Renting has real costs too. The difference is that owning comes with a set of invisible costs. Most buyers only discover after the closing documents are signed. The approval letter is not a financial plan. It is just the bank's calculation of their own risk tolerance. Now let's talk about the other anchor, the one sitting in the driveway. The dealership experience is worth understanding at a mechanical level because it is genuinely well engineered. Nobody leads with the total price of the vehicle. They lead with the monthly payment, and that is not an accident. By keeping your attention on a monthly figure, say $490, they shift the conversation away from what you're actually paying in total. To keep that monthly number feeling manageable, they extend the loan. 6 years, 7 years, sometimes longer. And the payment stays comfortable, the total cost quietly climbs. The average new car loan in 2026 sits above $48,000, and the average loan term has stretched past 69 months. Nearly 6 years of payments on an asset that loses roughly 20% of its value the moment you leave the lot. Here is where it compounds. By year 3 or 4 on a long loan, most borrowers owe more than the car is actually worth. When it comes time to trade in, that gap does not disappear. It gets rolled into the next loan. You carry negative equity from one vehicle straight into the next. The debt resets. The whole does not. Run that pattern across a working lifetime. Someone carrying a standard car payment of around $550 a month from their mid-20s to retirement, compared to someone who buys reliable used cars and invests the difference at a 7% annual return. The gap between those two paths reaches roughly $800,000. And not from a brilliant strategy, just from the compounding difference between a normal habit and a slightly less convenient. $800,000 is not an abstraction. For most people, that is the distance between retiring with real choices and retiring without them. Both traps follow the same logic. The house and the car are sold with the monthly payment front and center, and the total cost buried somewhere in the details. The system is designed around what you can technically afford to pay each month, not what it actually costs you over time. And those are just the fixed costs, because beyond the mortgage and the car payment, there are debts that do not simply sit still. They grow. And the way they are structured, they are almost designed to keep you paying indefinitely. Here is a number worth sitting with. The average credit card interest rate in the United States right now, for accounts that are actually carrying a balance, sits at around 23%. That is not a penalty rate for missed payments. That is the standard rate on a standard card for a standard account in good standing. And at 23%, debt does not just sit there waiting for you to deal with it. It compounds. It grows in the background. It gets heavier every month you carry it. Most people understand in a general way that credit card debt is expensive. What most people have never actually run the numbers on is how precisely the repayment structure is engineered to extend that expense for as long as possible. Here is the mechanism. When your statement arrives, there is a minimum payment listed at the bottom. On a balance of $11,000, that minimum might be around $60. $60 feels responsible. Your brain registers the task as handled. But at 23% interest, the majority of that $60 is consumed by the interest charge before a single dollar touches your actual balance. The principal barely moves. You paid. Nothing changed. Run that out to its conclusion. $11,000 in credit card debt, paid at the minimum each month, takes roughly 22 years to clear. By the time you make that last payment, you will have paid back close to $30,000. For $11,000 worth of purchases, you probably cannot fully account for anymore. That gap, nearly $19,000, is not a fee or a fine. It is the designed output of a minimum payment system built to keep the repayment clock running for as long as the math allows. This is worth saying directly because people sometimes assume it is an oversight. The minimum payment was not designed to help you get out of debt. It was designed to keep you in debt. That is not a conspiratorial reading of the situation. It is just the business model. A customer who pays their full balance every month generates almost no revenue for the card issuer. A customer who carries a balance and pays the minimum generates years, sometimes decades, of predictable income. Follow the incentives and the structure makes complete sense, even if it makes no sense for the person holding the card. Now let's bring this into a concrete situation, because abstract numbers only carry so much weight. Consider a household earning $110,000 a year. Both partners are working. Solid jobs, good salaries. They bought a house that the bank approved them for, financed 2 practical cars, and enrolled 1 child in full-time daycare. Nothing unusual. No obvious financial mistakes. Just a standard life in a mid-cost American city in 2026. Here is what their month actually looks like once the bills arrive. The mortgage, including property taxes and insurance, runs around $2,800. Two car payments add another $1,000. Full-time center-based daycare for one child costs roughly $1,200 at the national average, and that is on the conservative end for anyone within 50 miles of a major city. Add groceries, utilities, phone plans, honest minimum payments on a modest credit card balance, and total essential monthly costs land somewhere around $9,200. Their combined take-home pay after taxes is around $7,000. They are running a deficit before they have filled a single gas tank, before one dinner out, before anything breaks or goes wrong. And nothing in that budget is reckless. The house was bank approved, the cars are sensible. The daycare is average for one child, and every individual line item looks like a reasonable adult decision. The combination is what creates the deficit. This is what a normal life actually costs in 2026, and it is not an edge case. It is the math most families are quietly doing at the end of every month. Here is what makes it worse. When something unexpected hits, and it always does eventually, the only available tool is usually the credit card, which adds to the balance, which increases the minimum payment, which leaves even less room the following month. The debt does not stay expensive at a fixed level. It grows in exactly the moments when you are least positioned to fight it. So you have large fixed costs anchoring the top of the budget, and you have high interest debt quietly expanding at the bottom. That accounts for a significant amount of the pressure most households feel. But there is a third layer underneath both of them that is harder to detect, because it does not arrive as a single large charge. It shows up in small amounts, spread across a dozen different sources, and by the time you add it up, it has usually been running unnoticed for years. That is what the slow leaks look like, and it turns out they are everywhere. Here is a statistic that takes a moment to fully land. Nearly 4 in 10 Americans earning over $100,000 a year describe themselves as living paycheck to paycheck, not people at the lower end of the income scale. People with solid careers, respectable salaries, and by most external measures, a comfortable life. And when you look at why, the answer is almost never one large expense out of control. It is a collection of smaller ones, running quietly in the background, that nobody ever sat down and consciously approved. This is the layer of the financial trap that is hardest to see, not because it is complicated, because it feels completely normal. The first of these slow leaks is called lifestyle creep, and it is almost perfectly engineered to stay invisible. Here's how it actually works. You get a raise, a real one. You earned it, and it feels like the right moment to upgrade a few things. A nicer apartment, a slightly better car, the premium grocery store instead of the budget one, a gym membership at the place you actually want to go. Each individual decision is defensible. None of them feels extravagant. But what happens underneath, without any single choice feeling wrong, is that your spending expands to absorb every additional dollar you just earned. The raise disappears into a slightly more expensive version of the same life. Your savings rate stays exactly where it was before the promotion. And this is the mechanism behind that paycheck to paycheck number at higher incomes. It is not that people earning over $100,000 a year are irresponsible. It is that income and lifestyle have a reliable tendency to rise together, and the gap between them, the part that could become savings or investments, stays narrow regardless of what the gross income figure actually says. Now run the math on what that pattern costs over time. Take a $15,000 raise. If you absorb it into upgraded spending, the way most people do, it raises your standard of living modestly and leaves no lasting financial trace. But if you hold your lifestyle where it is and invest that $15,000 a year at a 7% annual return, over 25 years, it becomes just over $1 million. Not from a lucky investment, not from a side business, just from the compounding difference between spending a raise and leaving it alone. And that is the real cost of lifestyle creep, not what you are spending, what you are not building. The second slow leak is one that tends to embarrass people once they actually check. Before you keep reading, do a quick mental estimate. Without opening your bank account, roughly how much do you think you are spending each month across all your subscriptions? Streaming services, apps, software, news, fitness, cloud storage, all of it. Hold that number. And research consistently shows the average American spends around $219 a month on subscriptions. The average guess, before people are asked to itemize, is around $86. That is a $133 gap per month, every month. And around 42% of people are actively paying for at least one service they have completely forgotten about. The charge processes automatically. The amount is small enough to disappear into the noise of the bank statement. Nothing flags it as a problem. This is not a personal failure. It is exactly how the subscription model is designed to function. Small recurring charges spread across enough categories that no individual one ever feels worth the effort of canceling. The streaming service is $15. The app is $8. The cloud storage is $3. The professional tool you last used 4 months ago is $18. But none of them feels like the problem. Together, they are quietly removing over $2,600 from your year, and most of that is happening below the level of conscious attention. The third slow leak is the one that is hardest to argue against, because it arrives wearing the language of responsibility. An insurance agent, typically working on commission, explains that whole life insurance is really 2 products in one: protection for your family, and a savings vehicle that accumulates cash value over time. It sounds efficient. It sounds like smart financial planning. Why pay for 2 separate things when one product can do both? Here is what does not come up in that conversation. Whole life insurance premiums typically run 5 to 15 times higher than a comparable term life policy for the same coverage amount. The cash value component does grow, but slowly, and at a rate that almost always trails what a basic index fund would return over the same period. Consider a 35-year-old who chooses whole life over a 20-year term policy. The monthly premium difference can easily be $300 or more. If that $300 gap gets invested instead at a 7% annual return over 20 years, it grows to roughly $150,000 in additional savings. The whole life policy's cash value over that same period, more likely somewhere between $30,000 and $40,000. The math is not close. The product is not dishonest by design. For a narrow group of people with specific estate planning needs, whole life insurance genuinely makes sense. But for most working professionals who are sold on it as a general wealth-building strategy, it is an expensive solution to a problem that a much cheaper product solves just as well. The pitch is elegant. The numbers underneath it are not. So here is where things stand at this point in the picture. You have lifestyle creep quietly absorbing every raise before it has a chance to compound. Subscription spending is running more than double what most people guess, and insurance premiums cost 5 to 15 times more than necessary for the same basic coverage. None of these feels like emergencies. Each one feels manageable individually, but they are running simultaneously, and on top of the fixed cost anchors from the mortgage and car payments, and on top of the credit card debt compounding in the background. And underneath all of that, there is another layer. Not in the budget this time, in the way the brain processes financial decisions. And that layer might be the most expensive one of all, because it operates entirely outside of any spreadsheet. Here is something that does not get enough attention in financial conversations. 2 people can look at identical information, understand it completely, and still make completely different decisions. Not because one of them is smarter or more disciplined, because the human brain did not evolve to handle long-term financial planning. It evolved to solve immediate problems. And in a modern financial system built around delayed gratification and compounding timelines, watch that creates a gap between what we know we should do and what we actually end up doing. That gap has a name, several of them, actually. Understanding these psychological patterns does not fix them automatically, but it does explain why smart, capable people keep making the same financial mistakes repeatedly, and why willpower alone has never been a reliable solution. The first one is what researchers call the emergency-free delusion. It is not a clinical term, but the pattern is well documented. Most people operate their financial lives as if disruptions are unlikely, not consciously. Nobody sits down and decides they will never have a car problem, a medical bill, or a job interruption. It just does not feel urgent to prepare for something that has not happened yet. So the emergency fund stays underfunded, or does not exist at all. Currently, roughly 6 in 10 Americans say they could not cover a $1,000 unexpected expense from their savings without going into debt. And think about what that means in practice. A $1,000 car repair is not a catastrophe. On its own, it is an inconvenience. But without savings to absorb it, that $1,000 goes onto a credit card at 23% interest. If it only gets the minimum payment treatment, that inconvenience turns into a multi-year repayment with close to double the original cost by the time it is cleared. The absence of savings does not just leave you unprepared for emergencies. It makes every emergency permanently more expensive than it needed to be. The lack of a financial cushion is itself a cost. one that compounds quietly every time something goes wrong. The second pattern is one most people recognize the moment they hear it described, even if they have never heard the name. It is called social comparison, and in its financial form, it means spending money not to enjoy things, but to maintain a certain appearance relative to the people around you. The neighbor's kitchen remodel, the coworker's new truck, the colleague's vacation photos. The instinct to keep pace, or at least not visibly fall behind, is deeply wired. It predates social media by several thousand years. Here's the part that makes it genuinely costly. Most of what looks like wealth from the outside is financed. The kitchen remodel is probably a home equity loan. The new truck is almost certainly a 6 or 7 year payment, and the vacation may well have been paid for on a credit card that is still being paid off. The appearance of financial comfort and the reality of it are two entirely different things, and the gap between them is being funded by debt. When you finance your lifestyle to keep pace with someone else's financed lifestyle, the only guaranteed outcome is that both of you end up paying interest on the competition, and the only person who actually has to live with the financial consequences of your decisions is the future version of you. Nobody else is affected. The third pattern is the most structurally damaging of the three, and it has a formal name in behavioral economics: present bias. The human brain systematically overvalues what is available right now and undervalues what is coming later. A reward today feels more real and more compelling than a larger reward in 10 years. And even when the math clearly favors waiting, this is not irrationality exactly. It is just how the reward system in the brain is calibrated. Immediate comfort registers. Distant consequences do not trigger the same response. In financial terms, this shows up most clearly in retirement saving behavior. Retirement feels abstract. The version of you who will be 65 feels like a different person, someone you will deal with later, someone whose problems are not quite yours yet. So contributions get delayed. The employer match does not get maximized. The start date keeps moving forward to next year, when things have settled down a little. Now look at what that delay actually costs. Someone who starts investing $500 a month at 25 at a 7% annual return retires with approximately $1.2 million. Someone who waits until 35 to start the same $500 a month ends up with around $580,000. Same contribution amount, same return, same discipline. The only variable is a 10-year delay. The cost of that delay is over $600,000. Not because the second person did anything wrong in those 10 years, just because time is the primary ingredient in compound growth, and it is the one thing that cannot be recovered once it is gone. And this is what present bias actually costs, measured in real dollars. It is not a vague principle about valuing the future. It is $600,000 that no longer exists, because retirement felt like something to handle later. So when you add all of this together, the housing trap, the car trap, the credit card structure, the lifestyle creep, the subscription drift, the insurance mismatch, and now the three psychological patterns quietly undermining every good intention, what you get is not a story about bad decisions. What you get is a portrait of how a normal financial life in the United States in 2026 is structured to produce exactly the pressure most people feel. The system is not broken. For the people who designed it and profit from it, it is working perfectly. The trap is not dramatic. It is just the accumulation of individually reasonable-looking choices that compound in the wrong direction. But here's the thing about understanding a trap. Once you can see the mechanism clearly, it loses most of its power. And knowing where the exits are changes every decision that follows. Here is what all of this actually adds up to. The financial pressure most people feel is not the result of poor decisions. It is the predictable output of a system built around what you can technically afford to pay, not what things actually cost over time. The bank, the dealership, the card issuer, the insurance agent, and the subscription platform are all optimized around the same principle. Extract the maximum sustainable amount from your income for as long as possible. None of it requires malice. It just requires that you never stop and look at the whole picture at once. Now you have looked at it. The way out does not start with a budget overhaul or a dramatic lifestyle change. It starts with picking one trap, the one that made you pause while reading this. Start there. One adjustment, one redirected payment, one canceled subscription. Small actions compound the same way debt does, just in the opposite direction. The deeper question worth sitting with is this. And if the system is designed around your present self spending money, what would it look like to make decisions on behalf of your future self instead? That single shift in perspective is where a completely different financial story begins.